Yeah, pretty amazing.
All right, we got people filing in here, Jim.
All right, Federico, nice to see you again, buddy. He's working with those sophisticated people out west. So he needs
Likewise. Thank you for having me here. It's very
absolutely.
masterclass.
So this weekend, this week, this show, I wanted to follow up on some stuff that we talked about the last couple of weeks, last week, and I wanted to introduce a new topic that we alluded to last week. But I really wanted to back up a little bit and go through some basics that I got messaging on that people said, you know, we need some more foundation before we get into the upper stories. So I want to take a minute and do that, or I want to take a little while at the onset and do that, and then get into qualified opportunity zones. So there'll be a 1031 recap. And then we're gonna talk about straight line depreciation versus cost segregated depreciation opportunities and bonus depreciation. And then we'll talk about qualified opportunity zones. But if anybody, really what I'd love to have you guys do is, if you can, throw your screens on. And I want to say, like, this sounds kind of cheesy, but this is a safe zone, right? If anybody has any questions, don't hesitate to ask, because I can guarantee you, if anybody has a question, there's other people on the show that have questions. And so don't feel foolish because you're asking, because the only foolish thing, in my opinion, you could do is not ask. So we're going to do those 3 topics. We're gonna, oh, I gotta start my timer here so we don't go crazy. We're going to try to keep it to 30 minutes, 40 minutes. And we're going to have a question and answer at the end, and get you guys on the meat of the topics out in 30 minutes and try to get everybody out of here by 40. And if you have questions, please text them, put them in the chat, and Ryan will call it out because he's much better than me.
Kind of like come together, whatever. I'm sitting at the other end of the table, and we're all chatting, talking about guy stuff. And
That sounds like Beckett. That sounds like Ryan Beckett. I think that's Tiffany. He's with Tiffany or on a call.
All right, Ryan, go ahead and introduce yourself.
No, this is going to be a fun one. There's going to be some great information shared on this webinar, especially if you're working with investors like I am in real life. So my name is Ryan Poole. I'm the founder of Real Trade, which is an online marketplace and social platform for real estate. We have thousands of buyers and sellers using it, thousands of agents, and great service providers like Jim Brown using it to network with agents. And it's free for agents, so they love it. You get free leads. It's one of the best things, and a totally different business model than Zillow, which I believe is taking advantage of agents. But I'm an agent as well, in the trenches with you. Still working with clients after doing this over 20 some years. So, and I believe that if we can share information, we make the industry better and we make ourselves better. So glad to be here, Jim, with you on the webinar.
No, that's the concept, right? Iron sharpens iron. I get the privilege of, during the course of the week, realtors calling me up, realtors asking me questions. Then I take those questions and we turn it into topics for us to all talk about. If there's something that an agent calls me about, like the other day, I got some unique questions on service animals, then I can go and do the research and share it with everybody. And while that might sound like it's an unfair advantage to somebody who knows it and somebody else who doesn't, now we all know the rules on service animals. What it ends up doing is saving everybody time, right? So you're not getting into a transaction. The transaction was specific, right? This buyer tried to get approved in a high-rise condo with a dog that was half pit bull. Had the seller's agent understood the rules on service animals, they never would have even taken the contract, right? So even if it's a full price offer, a seller does not have to accept that offer. There's some misunderstandings about the MLS and offers and acceptances. So we can go into all that later. My point simply is, if we all know the rules, what Ryan was saying, we all save time. I thoroughly believe iron sharpens iron. We're going to give you some time-saving tools at the end. If you guys have future topics, again, please text and put them in the chat, and we'll get to them in the future. And the stuff that we can answer in a Q&A that I have answers for, we'll answer today. If you can put on your screens, I love the feedback. I love seeing your faces. When you get it, it reinforces me that I can move on. And I'm going to give you a tip. Read your contract 3 times this month and read it once a month, every month. You will have such an edge over the people you deal with. It'll be somewhat shocking. All right. getting right into it. 1031, I'm going to ask you guys some questions. I put an outline up called 1031 nuts and bolts, but I want to ask everybody, does everybody understand that a 1031, and just by a show of hands or nod or whatever, you guys can use your thumbs up in the chat. Does everybody understand that a 1031 is a way to defer taxes into the future? A 1031 exchange means you're selling property today and you're not paying appreciation on the capital gains, but you will be paying appreciation on the capital gains at some point in the future. So a 1031 is a tool that allows you to buy property for 500, sell it for 750, and instead of paying tax on the 750, roll the whole 750 into your new purchase. Let's say it's $1 million. Now you put another 250 into it and you got the whole benefit of the 750 sale. Instead of paying taxes on the 750, and then you have to kick in, let's just say 350 to make the purchase. You got the full benefit of the sale. So a 1031 does not avoid taxes, it defers taxes. So to speak, it kicks the can down the road. But then there are other tools at the end of the 1031 strategy you could use to avoid the tax altogether. So the things we're going to talk about today, cost segregation and 1031 are kind of locked up together. So if you don't understand 1031, I want you to say something, and I want to go into a little more depth. We got a small group today, and it works really well to do that stuff, that we have that flexibility. But a 1031 is a way to avoid paying appreciation on the tax, appreciation gain on the tax today. It also helps you avoid depreciation recapture. So if you have a property that went, like we talked about, from 500 to 750, the basis in that property, you bought it for 500 and you sold it for 750. But if you've been depreciating it at $20,000 a year, then every year the basis also goes down 20 grand. So when you go to sell it, you have depreciation recapture. So it helps you avoid both of those taxes, which can be huge. But here's the key to realtors is these are tools that you can use to get back in front of old clients. These are tools you can use to go out and get new clients. So when you use these tools, or when you use these themes, you can send emails to your clients, you can send texts to your clients, you can get in front of your clients again and again and again with new information. And now you're the relevant agent, right? And they're the one, they want to talk to you. So we're always looking for opportunities to get in front of our clients, reintroduce ourselves, reinvent ourselves, come back to the table with new knowledge. And they say, oh, Ryan, I want to know more about that. You send a text and you say, hey, I see, I hope you're cost segregating, or could we 1031 that property, or you find something interesting, let's 1031 that property I got for you last year and get into this other property. And so those are opportunities for you to build value in your client's head. And even if they don't execute the transaction, now Ryan is staying top of mind. And that's the most important thing. When they want to pull the trigger on a deal, even if it's not a 1031 deal, they find a property, they want to go look for property, they call Ryan, they want to sell a property because Ryan was the one who stayed in front of them this whole time with these value add propositions. It's not necessarily understanding every element of everything we're going to talk about, but it's understanding the concepts so you can get back in front of them.
No, I mean, I would just say as an agent perspective here, and I actually reach out my clients talking about 1031s and cost segregation. It's been there in my mind, but just having these webinars, it brings it to top of my mind, and that I can share with my clients. But anytime you're saving your clients money, right, where they have to pay less taxes, you're like a hero, because at the end of the day, I mean, you pay less money to Uncle Sam, it's literally money back in their pocket. So very, very powerful. And it's a great value proposition. It's differentiating you from all the other agents. 100%, Jim.
And you'll hear a lot of people talk about 1031, and they'll talk about 1031 in the classic sense. And that is, people say, don't do it. We don't have the time to get into a new property. There's an inventory shortage. Don't think of it that way. The 1031 should be done in reverse. And so that's something that you don't hear talked about much. But what that means is instead of selling a property and then buying a property with the proceeds, if the investor has the capital, they can actually buy the property they want to acquire first. So you go out of pocket and you buy that $1 million property. And then you're not under pressure to sell the relinquished property. But the trick is you have to give the money to the qualified intermediary before you make the purchase. So you go in your pocket, you give the qualified intermediary $1 million, you make the purchase, and then you can take your time selling the property. And when you sell that relinquished property from our earlier example of 750 grand, then you pay the 750 to the qualified intermediary, and the sale proceeds go to the qualified intermediary, right? And the qualified intermediary gives you the money and you put it back in your pocket, the 750.
Hey,
Jeff,
Jim,
you had your hand
Yeah.
up? Yep,
we
Go
have
ahead,
a
Jeff.
loan product called a bridge loan that allows you to do that also. So
exactly.
you don't have to have your own funds to complete that transaction. They'll give you, you have to, your debt, your loan to value has to be somewhere around 65, 70. But they will give you, they'll fund the two properties, the current property and the one you're buying. And it gives you 11 months. It's interest only. It's a great product that we have.
So that's a good point. And there's timeframes when you want to do a conventional 1031, when you're selling a property and you're buying a property, right? So when you sell, you have 180 days to acquire the new property. When you do a reverse 1031, where you're actually going out and buying your property, now you can pick and choose your buyer in your sold transaction using tools like Jeff mentioned, where you have these short-term financing opportunities. Now you can pick and choose the best offer on the property you're selling instead of being under that time constraint to acquire the new property. So it's a reverse 1031. You can read more about it on your own, but it's a reverse 1031 and they're super effective. I want to use the 1031 as a jumping point. If nobody has any questions, I want to use 1031 as a jumping point to talk about what we talked about last week, which was cost segregation. I'm going to update the outline with some ideas I had on some research I've done since we met last time. So there's bonus depreciation. I'm going to go back to the outline. Oh, wait a minute. Let's see. Screen share.
Yeah.
Bonus depreciation. So I've made a bunch of outlines. You can get them at newpathtitle.com. Are you guys, Ryan, are you looking at the cost segregation screen?
Yeah, that's great. I can see it. Yes.
All right. So at the top, there's a 1031 nuts and bolts. It goes into detail about what we talked about, not heavy duty detail. This is like a 5-minute, 10-minute read before you go meet with a client or you want to launch an email to a client. So then I made another one on cost segregation. We got proud and displayed at the top, real trade. So we got bonus depreciation. We'll go into that in a second. We got land value, how to determine that, and owners can even go back and cost seg properties. Okay, so I want to give you a cost segregation analysis example. So here's one that we can all relate to. This is a short-term rental. This is an annual rental. This is an example that Ryan wanted to see. So the property costs $1,200,000 and it's going to be rented out. And if you're going to say $600,000, you can take every single value and you can cut it in half. Without going into detail on this part, the illustration is simple. You acquire this property, and in the first year, under a cost segregation analysis, you're taking almost a $200,000 benefit. What does that mean? That means if the $1,200,000 property yielded you $100,000 in income, you paid no tax in the first year on that 100 grand in income. If you were using a conventional straight line depreciation analysis, you'd be taking somewhere around $20,000 to $25,000 a year. Here's the straight line. Here's the first year you acquired it. Here's the straight line. So every year, if you had that same $100,000 in income, every year you'd be paying tax on $75,000.
Got it. So let's clear this up. So basically, let's say you own that, your investor bought this 2
$1.2
million
annual rental.
they could write off the first year $200,000 of cost depreciation, which then if they're in like let's say the 30%, high 20s, 30% tax bracket, then they could take of that 200,000, write that directly off as on their income tax.
Right. So if that one property made you 100 grand gross,
Mhm.
forget about taxes and insurance and maintenance and everything else. Let's just say in this ideal world, you bought $1.2 million property and you put $100,000 in your pocket from gross rents, right? We all know that's not completely realistic, but for the sake of this discussion, that's the illustration. You would not pay any tax in your first year, and you would not pay any tax in your second year. So you would actually own that property 2 years and not pay any tax.
It's incredible.
Now,
then-
go ahead.
No, I was going to say then they could keep it for 2 years, make that income tax free, right? Could then, let's say in 2 years, sell it, 1031 exchange it, right? Now that property is worth 1.5 million, right? Not have to pay the capital gains on that difference from 1.2 to 1.5, roll it into the next
And roll
property
it
and
into
do
the next one.
and do the exact same thing the
Right.
next year. Now, if you can sell it as an agent, guys, and I'm working on this, with my clients, is you can sell them on this. Think about this. Now, every 2 years, you now have a great client where you're now not only listing the property for sales, you're finding another property for them for sale. And I mean, as an agent, that's, one of your best situations, right? Where you can get the listing and get the sale. And I
It's
mean,
an
just-
annuity.
Exactly.
You become their go-to, save me money, get me into a new property, annuity go-to agent. And so what are the nuts and bolts of this thing? So this is an abstract. This is produced by a company locally. This woman, Barbara, has been helping me a lot. I can give you guys her phone number in the outline, CCSSI. And this is all they do is cost segregation services. I want to show you an illustration. How does this happen? So what they do is they take your property and they break it down. They do a survey of the property and they take the property and they break it down into buckets. And so they take each element of the property and they put it into a bucket. So cabinets and millwork, here's the cost. And they say, okay, that fits in the 5-year bucket. So everything in this column, in this section up here, can you guys see my little cursor? I wish it was bigger.
Yeah. No, I can
So
see it.
everything in this section right here fits in a 5-year bucket. And so you have cabinets and millwork, moldings, flooring, all the fancy finishes, dock lighting if you happen to have it, security systems, window treatments, all these little fancy things. Also what would go in here are appliances. Don't ask me why this study didn't have appliances in it, but appliances, washers, dryers, dishwashers now, we all know they used to last 10 or 15 years. They last 5 years and they cost $500 plus. It's crazy. So all that stuff is a 5-year bucket item. Then they look at site work and improvements. We don't really have any 7-year items in the types of work that we're going to do. This would be like if you had like a laundromat, if you had like a dry cleaning business, you would have a lot of 7-year asset equipment. But then you jump, from the most part, what we're going to do is we're going to jump into the 15-year stuff. And the 15-year stuff is going to include parking lots and signage and sidewalks and landscaping and security lighting and fabricated steel bollards, the stuff that it's pavement, it's driveways, it's sidewalks, it's striping, those all go in the 15-year. And then the building and structure goes into the longer term stuff. So this is an Airbnb property, and we're going to go into the difference between Airbnb and annual rental. But this particular property is an Airbnb property. If this was an annual rental property and not an Airbnb, $1.2 million annual rental, or a six, you can cut all these values in half and say 600,000. Then this number wouldn't be 39, this
Sure,
would be
was it for
26,
Karen?
27,500. I mean, 27.5 years. Airbnb and commercial is depreciated straight line over 39 years. And this is all in the outline. Residential that rents annually is depreciated over 27.5 years. So then you've got all this stuff in this last bucket, which is structural framing, roofing systems, foundations, HVAC, electrical. I'm not real thrilled with this, the way this stuff was classified. I'm gonna do some more research and I'll update the outline, because I think some of this stuff's not necessarily 39-year. But regardless, the concept is they do the study, they put all these items in a bucket, and then you look at the effect of that. So here is a cost segregation analysis for a property. Don't get freaked out by this. It's not that complicated. I know it freaked me out the first time I looked at it. But here is a property that's rented annually. So this is that same $1.2 million property or $600,000 property. Cut all these values in half to get a general idea of how it works. And that's, I don't know why this thing keeps jumping around. So now this is all depreciated over 27.5 years because it's an annual $1.2 million rental property. Here's the total value of the building, 1.2. Oh, that's another good point. So we're talking about a building for 1.2. The whole purchase wasn't 1.2, and we'll go over the breakdown of that in a second. So we take that 5-year bucket stuff we had. So in 2023, you take $141,000 of that. And then in the 15-year, under the 15-year analysis, in the first year of the life of that asset, you can take almost $30,000. And then in the first year, in that 27.5-year bucket, you can take $19,000. So your total depreciation, see this 189 figure? That's where we came up with that value on that graph. That was almost 200 grand. So you take the total value of the 5-year assets, the 7-year assets, and the 27 and the 15-year assets, sorry, and you add it all together and you get $190,000. So if your property made 100 grand, now you're going to pocket that full 100, and you've got enough left over, you've got $90,000 left over, that you're not going to pay any tax on the second year. If you make 100 grand the second year, you won't pay any income tax. If anybody has any questions, don't hesitate to holler. It's not as easy to wrap your head around as it might appear, but it's also, I want to say, it's also not incredibly complicated. I mean, it's pretty much, you're finding a bunch of expenses that you can take early so that you don't have to pay income tax. And we're going to get to Ryan's point on the 1031 in a minute. Now I'm going to throw a little wrinkle at you. There's a element of the tax code called bonus depreciation. I don't want you to commit this to memory. Let's see. Cost segregation. Bonus depreciation for any assets that have a asset life less than 20 years. So in our examples, we had the 5-year assets, 7-year assets, and the 15-year assets, the features. Then you can add up the entire amount and take every 80% of that total value in the first year.
So you can front load this and take off, front load it and take it off in the first year. So it's, I mean,
so this is what's going to blow your mind. Exactly. So here's a mind-bending concept. You've got all this depreciation over the life of the property in the 5-year bucket, which totals 168 grand. You've got all these things in the 15-year bucket, which totals 36 grand. You can take the total of all those numbers times 80% in the first year under bonus depreciation. The bonus depreciation schedule is declining, right? So if the asset was placed in service prior to 2023, then you could take 100% in the first year. Prior to 2024, it's declining. Anything placed in service in 2023, it's going to be 80%. 2024 is 60%. All this stuff it goes beyond our pay grade to analyze and explain to our clients. What we need to explain to our clients is that there's bonus depreciation that can accelerate the cost segregation benefit. And then you can even go back. So the thing that I learned in between last we met and this time we met was you can even go back and cost segregate properties that owners were taking straight line depreciation on. So here's a great opportunity for a realtor where you sold a property to an investor a couple years ago, and you reach out to him and you say, hey, this is Ryan, and I just learned that you could go back and cost segregate this property that we bought together a couple years ago. You simply have to file a form with the IRS that instructs them you're going to recalculate your depreciation. From what I understand, it's not that exotic a thing for taxpayers to do. And so you file this form and you recalculate the way you paid your tax, and it allows us as agents to get back in front of investors and say, hey, did you know about this tool? And even if they don't use it, think about the value of Ryan Poole now, who just dropped his knowledge on the investor who's looking out for him. But now Ryan stays top of mind when Ryan wants to, when that investor wants to buy or sell. So the message to this story is you can go back and you can tell your old investors that there's tools out there that will allow them to accelerate their depreciation, avoid paying capital gain, avoid paying taxes today, if they want to take advantage of them. And then that gets you to Ryan's point earlier, which is, hey, after 3 years or so, they're going to want to flip that property to reset the cost seg calculator on a new property. And that's a 1031. And that's why I want to take so much time and explain 1031s this morning a little more detail. So you've got, I call it boot. And I've seen some of the people who talk about it as like boot. So you've got this depreciation boot, right? And it's really heavy for the first 2 or 3 years. But then after that, it's going to tail off. So
Great info, Jim.
I mean, just,
like you said, we just want to, I know this is a lot to wrap our heads around as agents, and we're not accountants, right? We're not, tax, consultants, but we can let our clients know we have a great way for them to save money, and they should buy more property.
I have a question, guys.
Yep, go ahead.
So in order to do this and fill out this form with the IRS, this analysis is required, and what's the cost of that?
These cost seg studies range from about $1,000 to $5,000. I'm going to give you a little list of people. It's best if when you talk to your clients, if you give the client 3 references. If the client says, hey, I want to pull that trigger, Tiffany. If you always give a client 3 references, you're going to be safe with regard to steering. You don't want to be deemed as steering business any one particular way because you have a relationship with so-and-so. I always say, here's three consultants. We really like all 3 of them, and we've worked with this one a lot. And we know that they do a good job, but you don't want to be heavy-handedly steering. So they're $1,000 to $5,000 typically. They're going to be less expensive for the types of properties that everybody on this show today deals in that I'm aware of. They're a little bit more expensive if you start getting, and they can be a lot more expensive when you get into hundreds of millions and many, many $1 million commercial properties. Most of these studies can be done without the cost seg expert coming to the property. And what the cost seg expert does is they give you a table. It looks very similar to this. And then you use this table, provide it to your CPA. When your CPA does your tax return, this is the basis for why the CPA got the depreciation, requested the depreciation they requested. Does that make sense?
Yeah, and I have a question as far as if an investor bought a property 15 years ago and never utilized this and is getting ready to sell, would there be a benefit of them getting this done, or would it just be a benefit to the buyer? Is there any
No, it would
benefit
never
to the seller to go
benefit
back
the
there?
buyer, but you can go back. I do not know exactly how far back you can go. I think in some of the readings I saw, you can go back to 2017 and get cost seg benefits, maybe even before 2017. I could figure out the answer to that question. How
But as far as a
far?
benefit to the seller, I mean, if they're getting ready to sell it, would it still be a benefit? Would they get a tax credit? I'm just a little confused at.
Yeah, absolutely. So one of the things you could do is you could go back, say you bought property 5 years ago. I have a couple properties I bought 5 years ago. I'm going to get a cost seg study done on them. And I'm going to get a bunch of depreciation benefit. Even if I sell the property in a couple of years, I'll still have those credits moving forward. So
Okay,
let's
that's
just,
what you're saying. So you can then use it to buy. That's the whole point.
well, you can use it to offset. That's 1031.
Okay. Oh, okay.
From the cost seg perspective, I know it gets blurry when the more you think about it, sometimes it gets even blurrier. But from the cost seg perspective, think about it like you have this credit in the bank. And so if in our earlier example, you have the 1.2 million property and you have $100,000 in lease revenue. Forget about expenses for taxes and insurance and repairs. You have $100,000 you're putting in your pocket. If you get a $200,000 tax deduction, income deduction, now you've got another 100,000 you could roll over to the second year, right? If you get 200 grand in boot the first year and you have 100 grand in income, now you can soak up 100 grand in the credit for the first year, but then you've got 100 grand that you could roll over for the second year. If you sell your property before the second year comes, you still get that deduction.
Because
Makes
they're going to be
sense.
billed in arrears anyway.
Because it's not arrears, it's just a credit that Tiffany gets because she had this piece of property. And just because you sold the property doesn't mean it goes away. But the most important thing is you can go back to earlier properties you've owned that you've done straight line depreciation, but you can't even believe how many people have
Oh.
never taken depreciation on their property, not even straight line.
Yeah.
So
Oh,
we're
so
talking,
interesting.
yeah, so we're talking about here's the straight line depreciation. Let's see, 27. See this column right here?
Yes.
Mhm.
See
20.
this column where it says 27.5 year depreciation analysis, depreciation without analysis.
Mm-hmm.
So
The
this is
difference
what your
with.
depreciation looks like if you never cost segged the property. You take
Wow. What a
23
difference
grand,
from that.
yeah. So let's just say you sold the property in 3 years. You would only have deducted this. Oh, I hate the way this thing jumps around. I'm sorry. I was trying to highlight something, but it doesn't work. So you would only have deducted this year, and this year. So your total deduction from income, while you had 200 grand in income, you only would have deducted, let's say 90 plus 20, $110,000 worth of depreciation, where under the cost segue, you would have deducted all your income from taxes, from taxable income.
Got you.
Yeah, 90
Okay, wow, great. Thank you for clearing that up.
total depreciation without analysis. Yeah, so this is the column that shows the depreciation opportunity under a straight line scenario. So they take the total price of the asset and they divide it out over 27 and a half years. Here, they take the total value of the asset and they put it in buckets and they speed everything up. And if you take bonus depreciation, now you've put those buckets on steroids and taken it even quicker. And again, the bonus depreciation schedule is is decreasing over time. It may be reintroduced. It's been very successful. They talk about it comes and goes throughout history. If you look at the taxing history, bonus depreciation has been calculated and recalculated, and it comes and goes. And even 1031s, it's good to mention 1031s, they talked about at the beginning of the Biden administration, not taking political sides, but at the beginning of the current administration, there was discussion about doing away with the 1031 rules. There was, I can only imagine there was a ton of senators and a ton of congressmen on the floor when they had to vote on whether the 1031s were going to go away, that they had 1031 pent up gains. Regardless of my political views, it didn't get done away with, and I wouldn't imagine it's going to get done away with. The other thing is, when you look at property value, I'm going to update my outline. When you look at property value, a general benchmark would be when you want to figure out what portion of the property can be cost segregated. It's everything that's not the land, but the parking lots and the improvements to the land can be cost segregated. But how do you determine the value of the land? There's a general rule that if the taxing authority says that this is the value of the land for the purpose of a cost segregation study, that's an acceptable value. And we all know that the property appraiser, the tax collector, values the land and the sticks and bricks conservatively. So that's basically the value you're going to see as a standard rule when you do a cost seg study, as left out from the purchase price. So if you have very expensive land and cheap sticks and bricks, it's not going to be a good cost seg property. But if you have very expensive sticks and bricks and cheap land, that's going to be a great cost seg property. So keep that in the back of your mind. I'm doing some more research on business condominiums, like you see where the businesses have air conditioning shops in the front and the trucks are parked in the back. You see those strips of those commercial complexes. But the one that I do know is really, really good is, and I think we talked about it a little bit last time, is self-storage facilities. So when you see self-storage facilities and you walk in and it's got these little flimsy partition walls with the corrugated steel, and they've got the really inexpensive flimsy roll-up doors and things, that's all 5-year cost seg. Those are all 5-year cost seg assets. So that's why that's a big reason why you see self-storage facilities. Yes, they do make money. Yes, they are traded frequently. And the reason they're traded frequently is because they make money, but they also are a great way to get depreciation to offset income. So how can an asset that has, let's just say, a 30 or 40 realistic lifespan be traded every 3 years to get the cost seg boot? Or why is it traded every 3 years? Because they took that cost seg boot in the first 5 years of that self-storage facility, and now to reset the clock, they go and buy another self-storage facility and sell that one to get another 5 years of heavy duty depreciation. 3 to 5 years of heavy duty depreciation.
And the new owner that's buying the self-storage can go through the same process themselves.
And that's the thing that blows my mind.
Which is incredible, right? So they can front load it and get the cost depreciation. And this is why real estate is such a great investment. I mean, there could be almost like a consortium where they're basically selling these assets amongst themselves. People, I mean,
that's, yeah.
You know what I mean? There's a bunch of things here that could happen.
If I had, so what Ryan's explaining is, if I had a self-storage facility and Ryan had a self-storage facility, at the end of 3 to 5 years, I sell mine to Ryan and Ryan sells his to me, and we pay market value, but that's fine because we're getting huge deductions from income. And the other thing is, there are very few properties to buy right now because everything is pumped up typically. And so this is an opportunity to buy at market and still provide value to your buyers.
That is, that's one obviously objection as an agent, I'm hearing, right? I'm sure other agents are here. Well, it's the top of the market, I mean, I'm paying, top retail price for this. And you can go, okay, I understand, but let's look at the cost segregation, that you can do for this property and look at this money you're going to save. So, it's basically another quiver, another arrow in your quiver, right? That that you're going to be able to help you close deals. And that's why we're all here, right? To make more money, help our clients save money, and everybody wins.
So there's another concept called real estate professionals, and I'm not going to go into the difference between active losses and passive losses, but there are lots of people who deal in property on a regular basis that could qualify as a real estate professional in the eyes of the IRS. And what that allows you to do is, we had our example of $1.2 million property, and they were taking $200,000 of depreciation in the first year, but they only had $100,000 of income on that property. So you have missed opportunity on that $100,000 of depreciation. If you had income in other elements of your life and you were qualified as a real estate professional, you and your spouse, say you made $100,000 in stocks and securities, you and your spouse could avoid paying income tax on the other $100,000 if you were deemed a real estate professional in the eyes of the IRS. And there's certain time constraints that you have to meet in order to qualify for that. And so what you want to do is you want to make sure that you qualify, but if you do qualify, that's something you want to take advantage of, because then you could take all that depreciation in year one and put it to work if you wanted to in other elements of your life, not just your real property. All right. So we are 39 minutes in. I haven't covered qualified opportunity zones. I have no problem stopping or continuing on. And let's see if I can get everybody, let's see, stop share. By a show of hands, who wants to go into qualified opportunity zones, and who wants to make that for a next session topic?
Yeah, that's a whole topic in itself. You know what I mean? The opportunity zones, but that's a huge leverage, right? That investors can purchase. And there's some great spots right here near downtown West Palm Beach, Northwood in particular, that that they can take advantage of.
Why don't we just briefly go into qualified opportunity zones if nobody has an objection? And we can go back into it a little bit more in the future. Let's see, there's a chat. Where can I download the stuff? You can download the stuff there's a link at newpathtitle.com in the masterclass. You hit Realtor Resources, newpathtitle.com, click Realtor Resources, you'll see a drop down, and you look at Masterclass, and there's going to be outlines and videos in the Masterclass under the Masterclass topic. So let's go in and we will briefly talk about qualified opportunity zones. Screen 2, share. All right. Can you guys see, Ryan, qualified opportunity zones on the screen?
Yeah, we can see it.
All right, so qualified opportunity zone. Think of it like a 1031 exchange on steroids, because there's a possibility you could never pay the tax. So in a 1031, we talked about at the onset, you're deferring your tax burden into the future. You're either going to potentially pay when you have a lower tax bracket, or you could 1031 into personal property, eventually hang on to it for 2 years and never pay the tax, or you could put it in your estate and when you pass away and you get a stepped up basis to your heirs. Forget about all those details. A 1031 is a way to defer your tax burden into the future. And maybe you could avoid the tax altogether under a couple of strategies. A QOZ, a qualified opportunity zone, allows you to avoid the capital gains tax immediately, as long as you do a few things. So think of it like a 1031 on steroids. And here is a map Ryan dug up of the 1031 opportunity zones in the United States. And
Jim, this is so
here's,
great. I have an appointment tomorrow, a listing appointment, and this client has owned 7 different parcels. What we were talking about before, wanting me to find a buyer. And they're now being zoned for opportunity zones. what I was mentioning before. So this is a
Cha-ching.
perfect topic. Yeah.
So here is the qualified opportunity zones locally, and we'll go over the rules briefly. We can go into them in more detail. But here are the qualified opportunity zones locally, and there's West Palm Beach, and there's all kinds of areas outside of Okeechobee. And moving north, there's Indiantown. So there's a lot of good stuff for us locally. And the cool thing about the qualified opportunity zones in our area is some of these QOZs happen to be right on the fringe of some really desirable areas. So there's an opportunity to do some holding, land banking, property banking, people with long-term vision. There are a couple of investors that we work for, and they're bigger investors, and we were doing a little research, and some of these national investors, one company owns 163 properties in this qualified opportunity zone. So you know they see value there long-term. It's either, it might even have been more than 100. It was a lot of property. I think it might even have actually over 200 properties. So what is a qualified opportunity zone? The federal government identified some QOZs throughout the US and in Florida. Here are some highlights of qualified opportunity zone investing. Can you guys see this? Is it big enough? An investor can defer capital gains on real property they are selling. That's the relinquished property. Think of 1031s when we talk about relinquished and acquired property. Relinquished property is the sold property. Acquired property is the property you're acquiring. Acquired property has to be in the QOZ. When they invest, wait, what did I do? When they invest the proceeds in a qualified opportunity zone, investor can defer capital gains on a non-real estate sales, stocks, bonds, and securities as well. That's a whole nother discussion. So we're only talking about the real property part. An investor buyer can avoid future capital gains by purchasing property in a qualified opportunity zone. The purchase of a qualified opportunity zone property has to be through a qualified opportunity. So here are the rules: qualified opportunity fund. But the fund, don't think of it as a typical fund that somebody else sets up. You actually start your own qualified opportunity fund and fund it yourself and designate it yourself and report on it yourself. And it's not that big a burden. Your CPA can do it with you and for you. And we'll go into more detail the next time we meet, but we'll talk more about a little bit of establishing the fund, but it's not hard. It's an LLC, a corporation, or a partnership. The qualified opportunity fund gets the fund designation by filing a specific tax return form as an independent entity, and the IRS gives that designation. Qualified opportunity funds are designated by the IRS filing and self-monitored. The fund must invest at least 90% of its assets in the qualified opportunity zone. To avoid capital gains on the relinquished property, to avoid capital gains on the property you sold, the investor has to close within 180 days of the QOZ property they're buying, kind of like a 1031. And what are the tax advantages? Here's where the rubber hits the road. If the QO fund investment is held for 5 years or more, 10% of the capital is excluded from the tax, 10% of the gain is excluded from the tax. So on a $100,000 capital gain, you'd only pay tax on 90. But if it's held for 7 years or greater, 15% is excluded. If it's held for 10 years or more, the basis is pumped up to the fair market value of the property and the capital gain is not taxed. So,
Hey, Jim, is that actually the QO fund? Is that actually like an LLC of some sort, or?
yeah, so you would open and file an LLC just like you file any other LLC. And then you would get quality opportunity zone funding designation by filing a form with the IRS. And then I'm going to go into details next time about what that really means. But basically, you're going to designate yourself a fund, and then your CPA is going to help you monitor, and your accountant is going to help you monitor your expenses. And then you're going to submit your expenses to show that you qualify for the fund designation, self-monitored. But here's the cool thing. So you bought that property we talked about earlier for 500 and you sold it for 750. And you would have paid capital gains on the sale when you sold the property. but you invested the sale proceeds, the full 750 in a qualified opportunity zone. So now they paid no capital gains because you invested in a QOZ. And if you hold it long enough, then you don't pay any capital gains on the property sitting in the QOZ. And we'll go over some illustrations next time and things like that. What does it take to be, does anybody have any questions so far? There's a million questions I'm sure you have, but I think next time when we have a little more time, we'll go into a little more detail. I think it'll help clarify things. Maybe we'll do service animals and finish up QOZ. So what are the property requirements within the QOZ? It has to be new construction or property vacant for at least 3 years prior to the purchase. And then you substantially have to improve the property. So investor reinvests an amount equal to the value of the building within 30 months. For example, the purchase price is $1 million. The land is 400 and the building is 6. The investor has 30 months to invest another 600K improving that property. And then all brownfield sites are QOZ property. And we can look at a map of all brownfield sites in the future too. We're 50 minutes into it, you guys. I don't want to I don't want to give anybody deal fatigue. I want to kind of get in, talk about it. You guys go out and do some research on your own. And then when we come back together, we'll talk about qualified opportunity zones quickly. And you guys will have hopefully some questions after you do some reading on your own. And you can get these outlines on newpathtitle.com. I'm sorry about the alarm in the background. And
Jim, I still
it's
don't
good.
see where to get the outlines. I'm sorry, I don't. You said you go to Realtor Resources, and I know I have the website. Under
go right
Realtor Resources,
here.
under the talks.
Let's see, you go to newpathtitle.com. Then you go over here to Realtor Resource, and then you have Masterclass event. And so here are the old past events.
Okay.
Read more. Looks like he
Hi,
doesn't
Jim.
have it.
Let me chime in then. So once we finish the masterclass, I would be posting them. So if you click on the current masterclass that says Real Estate Wealth Secrets,
Mhm.
right now it's just a registration. But after the class, we're going to post a YouTube video into here. And next to it, there'll be like notes of what was discussed, the transcript, and any links that Jim provides.
Okay.
And that'll be the same thing in these, Ryan? They'll
And
be
so
able to
for
click-
the existing ones, yeah, as of right now, there's no PDFs that are available to click on, though, correct?
Let's see.
No, I don't see anything.
Okay. I just wanted to make sure I wasn't crazy.
Okay, if you go to the far bar or the masterclass S4D far bar addendums, the March 21st one,
Hmm.
and you scroll a little bit down, you'll see the discussion tab there, and then there's a Realtor Resources with links.
I'm not seeing that on my end. I see when I scroll down, it says discussion topics.
Ryan, do you mind copying and pasting the link on the chat so we can all copy, please?
Well, I think what Alex is saying is we got to get more caught up. So
Oh, I
Alex,
see.
here I'm on the real estate masterclass navigating the Florida bar contract. That was the one we did in January.
Yeah, I just clicked on that one and I see where you have uploaded them. Okay, perfect.
Where is the outline?
So you have to go to an older one and it's under Realtor Resources. I'm sorry, the discussion.
So here we have Realtor Resources. Alex, are you with us?
Yeah, I'm with you.
So we have masterclass events, right? And now
And
you're
then click
saying
on the one from March 16th, SB4D.
SB4D. No, I did the wrong one. March 16th.
Yeah, the March 16th one has them. Under discussion topics, you can Realtor Resources.
I see March 21 and I see March 7th and February 21st. Which one?
March 21st.
March 21st. So you scroll down. Okay. Wonderful.
And we're redesigning this page for it to be simpler to use and for it's easier to find resources.
So basically, everything is going to be under Realtor Resources, under the masterclass topic. Alex, is there a way we could combine the masterclass topics and the title talks, or not? Is that not a good idea?
Yeah, we could.
Yeah, I think then it's all in one place and people can just go to one spot. All right, Ryan, blow yourself up, tell them how great Real Trade is. I think it's the future of real estate platforms, no exaggeration. I had an agent call me the other day. She said she wanted me to help her with her Zillow advertising. Her budget was $10,000 a month. I said, A, I don't do that stuff, and B, you got to do something different with how you spend your money.
No, thanks, Jim. I love doing these. It's been great. Thanks you guys for attending. But you know, I designed Real Trade from an agent perspective. I wanted to solve the big problems with Zillow and these other online portals, how they're taking advantage of us, especially off our own data. It's incredible. You know, we all work really hard for listings and our properties for sale, and then we can't talk to buyers to sellers that are generated off our own listings. So the cool thing with Real Trade, even if you just created a profile, the nice thing is we pull all your listings in for you, put them underneath you, and now you're the point of contact. So, you know, and there's agents that have made 50 grand or more just from Real Trade by, you know, making a profile. That's the first thing. So do that. It takes about 15 minutes, right? The second thing is we have these amazing tools that you can use now to gain more clients and sell properties quicker through a whole social aspect of the platform. You can post buyer needs, live listing updates to your listings then that notify buyers and sellers that there's additional information, which drives them now to more buyers and sellers to the platform. So it's very unique. And the best thing, guys, it's free for us agents. You know, I mean, you know, that's one of the best parts. The cool thing is you can network with service providers that you're going to need in your business, whether it's a title company, awesome title company like Jim, whether it's an inspector or a contractor, or we have solar companies, you name it. They're there to help you close more deals and facilitate business. So like I said, the best part is it's free for agents.
I always say it's the shortest route to the double dip too, because buyers are on there and they can go right to the seller's agent. And if you're a buyer's agent, every seller's agent knows 10 people who want to list and they're just not listing. And now if you're a buyer's agent and you go and advertise a property you're looking for, you can dig up a whole bunch of sellers agents that can nudge their sellers and say, look, now I actually have a buyer for you. Let's do a deal. I just realized that when I was explaining everything, I wasn't showing you guys anything. So if you go to New Path Title, I just realized the screen share was off. If you click on Realtor Resources, you can click on Masterclass Events. And then as Alex was saying, you can go to the older events and you can click on this one. Here's one we did on the SB4D. And here's all the links we were talking about. Can you see this, Ryan? Is that all? I just realized when I was explaining it before, it wasn't on the Masterclass. Oh, on the screen share. Oh, and while I have you guys, I just got a article. Oh, somebody took it. So this whole fake sellers thing, we talked about it the other day. In the meantime, we've taken a client that was a seller that had their property sold out from underneath them. And there's 2 articles that came out in national periodicals all about fake sellers. So don't burn calories on fake sellers. I want to take 2 seconds and self-promote. So we have Title Advance realtors are using to go out and get listings very successfully. And Title Leap is helping realtors save a ton of time in their closings. I got a call from a realtor the other day. She said, you guys make me look like a rock star. I'm going to use you forever. And the Title Leap absolutely distinguished me to my clients. And at the end of the transaction, my seller was just praising how good it was to work with New Path and specifically Title Leap.
Yeah. I want to just give it one shout out to Jim here in Title Leap software. It's literally like a free contract coordinator, guys, for you as an agent. We're all busy. We have a lot of deals we're working. The nice thing is they keep track of your drop dead dates. And, you know, whether it's your finance contingency, your inspection, your second deposit, it's all there right there in front of you on the dashboard, and they notify you too as well. So it keeps track of all your deals. Everything's in one place, all your contracts, your addendums, closing documents, they live there forever. So if your clients ever have a question after they close about something, it's all right there in one place. And I'm a huge huge advocate of it. It's made my life a lot simpler as an agent, especially doing everything yourself. So
TITLEADVANCE.io. And if you're going on a listing appointment,
Oh, this is not-
TITLEADVANCE. What's going on with title advance? TITLEADVANCE.io. All right, so what is going on? Title advance, TITLEADV, Alex, any idea why this isn't coming up?
No, not sure.
All right.
I'll check.
So we have another product, titleadvance.io. You guys are going on listing appointments, go to titleadvance.io. We'll get the site back up. We just booted it up a couple weeks ago. It's working very well for people. Tiffany uses it all the time, and we have reports from other people they're using it, and they show up and that they look like the most sophisticated seller's agent. They win the listing, and obviously they know everything that's going to be in their path on the way to closing. So it really helps in the closing process. This is the best part of my day. Thanks for sharing it with me. We were here for an hour. I'm going to get you out of here. Hopefully you got some value. Go out and sell a bunch of property and let's make some money.
All right. Thanks, Jim. Thanks, everybody.
See you guys.
Everybody.